Hi everybody, this is Carlos. Welcome to geekfinance.org. Today we'll be talking about double entry accounting, debits and credits, and the accounting equation. Please visit geekfinance.org if you would like to download today's PowerPoint, as well as other resources such as spreadsheet templates, problems, and more. As always, our first slide contains today's formulas and definitions to make them easier for you to find in the future. Double entry accounting can be traced back all the way to 15th century Italy and to this man, Luca Pacioli, commonly regarded as the father of accounting, who in 1494 wrote a textbook where he described the basics of double entry accounting and which we use to this day. Double entry accounting has three basic rules which we're going to go over. The first one is that every transaction has to affect at least two accounts. Now, I know it doesn't make sense at first, but when you practice it, you're going to realize that in every financial transaction that you perform, there's going to be at least two accounts that can be recorded. Since the best way to learn is by example, let's dive straight into one right now. So it's January 1st, 2019, and you just made a New Year's resolution to start keeping track of your finances. Being that you're a business student, you realize that this will be a perfect opportunity to practice your accounting skills. So you start a journal where you will record all your financial transactions for that year. That morning, you're walking down the street when you realize you haven't had any breakfast and you left the house without any money. Luckily, you run into your friend Jesus and you ask him to borrow a couple of dollars. Jesus agrees and hands you $2 and then goes on his way. So here's our first transaction of the year. You borrowed $2 from your friend. And in order to make our first entry, we have to analyze the transaction and find out what has changed. Now, the obvious answer is that you're up $2 in cash. So we're going to record that in your journal as a $2 debit to cash. But remember, we have to make at least two entries for every transaction. So we have to think what else has changed since this morning. Well, you're up $2 in cash, but you're also $2 in debt with Jesus. You now have $2 in cash and a $2 debt which need recording. So we're going to do that by crediting debt for $2. So you see, every transaction has at least two outcomes that need to be identified and recorded. But let's keep going. So you're now at your local gas station and your stomach is grumbling, and so you decide to get some candy bars. You decide to spend your $2 and buy two candy bars for $1 each. So here's our second transaction for your journal. Now, if we analyze our transaction to see what has changed, we instantly notice that you're down $2. So we're going to record that as a credit to cash for that amount. But what should be our second entry? What else has changed because of our transaction? Well, we now own $2 worth of candy bars. And this can be recorded as a debit to candy bars for $2. So as you can see, double entry accounting just requires looking at the transaction and figuring out which accounts have been affected. The more you practice, the easier it will be to spot them. Now, if this is your first time studying accounting, and if you're watching this video, it probably is, you might be wondering why I keep using the terms debit and credit instead of adding or subtracting. This is a great question, and it brings us to the second rule of double entry accounting. The debits must always equal the credits. To see what debits and credits are, I have to introduce you to these. These are your T accounts. Now, when you started writing your journal, it was organized into dates, so that each date listed all the transactions that were performed on each specific date, independent of what account was being affected. Well, your business's ledger will be organized into accounts, and these represent each different account separately and record the value of the transactions independent of the date. So the cash account will record all the movements in cash for a reporting period. The debt account will record borrowings and payments to your debt for the whole period, etc., etc. Now, you'll notice the left side of the T account is called a debit, and the right side of the account is called a credit. So where are we going to record the increment? Is it in debits or is it in credits? Well, that depends on the type of account we're talking about. Now, there's 5 different types of accounts: asset accounts, liabilities, equity, revenues, and expense accounts. The assets represent resources your company controls, like cash, inventory, property, plant, and equipment. Liabilities represent your firm's financial obligations, like debt or accounts payable. Equity represents the owner's claim on the company's assets. Now, this includes contributed capital, which is the money that investors put up to start the business, and retained earnings, or the money that has been generated by the business but hasn't been withdrawn by the investors. Revenues and expenses are pretty self-explanatory. So, in order to know which side of the T account to use for increments and subtractions, you need to know how each type of account behaves. For asset and expense accounts, increments or additions will be recorded on the debit side, while subtractions or declines will be recorded on the credit side. The rest of the accounts behave in the opposite way, so that increments or additions to the liabilities, equity, and revenue accounts are recorded on the credit side, while subtractions or declines in these accounts are recorded on the debit side. So let's practice posting our journal entries to our ledger. The first transaction involved a $2 cash increment and a $2 debt increment. Since the cash is an asset account, we will post this increment in the debit side of the account. The debt account is a liability account, so in order to post an increment in debt, we're going to have to post it on the credit side. Notice how after recording this transaction, the debits and the credits are equal. The same will happen for our second transaction. We have a $2 decline in cash. Since the cash is an asset account, we're going to record it on the credit side this time. We also have a $2 increment in candy bars. Since these are an asset, we're going to record it as a debit for $2. Again, notice how all the debits and the credits are in balance. The last rule for double entry accounting is that accounting equation must always be in balance. The accounting equation is assets equals liabilities plus equity. And once you get familiar with it, you'll begin to see why it makes sense. You see, the right side of the equation, liabilities plus equity, represents the source of the capital your firm is using. You know, where's the money to run your business coming from? Is it from investors or is it from creditors? Did you issue stock? Did you take out a loan? And the left side of the equation, the asset side, represents what you're investing that capital in. You know, did you buy machines with it or did you buy inventory? Another way we can look at the equation is like this. Assets minus liabilities equals equity. Now, I wanted to point this out because this kind of reinforces the idea of equity as the claim of the owners on the assets after all obligations have been met. So if you take all of the assets of a company and you liquidate them and you pay off all your creditors, whatever is left belongs to the owners. So when you're looking at the equation, you're probably wondering where the revenues and expenses are. Well, they're right there. It's just that they're kind of grouped into the equity part. In order to see this, we can expand the equation and divide equity into contributed capital, which remember is the part that the owners put up to start the business, and retained earnings, which is the part of the capital that has been generated through the business's operations, but has not been distributed to investors. And so we can further expand the equation by breaking up retained earnings into revenues minus expenses minus dividends. In our example, I'd like you to notice that the asset side of the equation is represented here by our two asset accounts, which are cash and candy bars. Our liabilities plus equity side is represented here by our debt, which is a liability account. Now, in a real business, we'd also have at least one equity account representing the capital that the investors put up to start the business. So when we record our first transaction, which is an increase in assets, you can see that the other side of the equation suffers an equal increment, which keeps both of the sides of the equation in balance. Now, as we see when we perform our second record, an increment in assets can also be offset by a decrease in another asset, which again keeps the equation in balance. This is all I have for you on this subject. Check out geekfinance.org to find more videos on accounting, finance, investments, and more, as well as other resources such as spreadsheets and problems and solutions. Study hard, guys.